All right. Hey, good morning. Hope everyone's thought out and ready to go today. I know a lot of guys I talked to yesterday said that they were just going to take the rest of the week off because it was going to be too cold. So hope everybody is safe. Let's jump right into it here. I guess a couple of housekeeping things before we jump in. We've been talking and reviewing what we're doing here on Wednesday mornings, and talking to a lot of you guys and a lot of our new subscribers, and watching when people tend to watch these videos. And it's 80% plus like to watch them online. They like to watch it off the email link later on in the day. And one of the most common um, um, items of feedback that we get is we wish you did more of it. So what we're thinking about doing is um, uh, is is doing more videos like Monday, Wednesday, Friday. I don't want to do them every day because I really think people will get too bogged down in the weeds on them. But what we're talking about doing is doing them every like 3 times a week, and sending those out either all by link and doing none of them live, or by doing one live and sending two out by link. So we'll be asking some questions and figuring out what you guys want first. So if you have opinions on that, please give us a ring. We chose 7:30 on Wednesday morning several years ago as kind of a shot in the dark as to when people would be the most available and have an opportunity to spend 20 minutes. And that's been great. Some weeks we have upwards of 20, some weeks we have two or three, all just depending on cycles and where they're at. And that's great. We always appreciate the live participation. But is it easier to call in live? Is it easier to get a link? What do you want? So if you could let me know, shoot me a text, or Jeff or Phil or whatever, and just tell us, give us some feedback there. All right, let's jump right in here and kind of take a global look. So next week we're not going to do this. We're going to be out. I expect the market to be really quiet. So this will be the last one for the year. And so let's review where we are with corn, wheat, and beans, and what we think is about to happen. Okay, so with corn, this is our daily chart of March corn. We've had the steady march lower from the early November low. This has unfolded in 5 waves. Here's 1, 2, 3, 4, 5. It's crystal clear. It's perfect. It makes all kinds of sense what we did, and we are now in a correction. Now, today, we could either be done with this correction in we could have an A, B, C up and done here, and this would be a 1, 2, which what follows then is a rollover and die, and that challenge down into this 580 level. Or we could push it just a little bit higher as an A, B, and come right back up into this 670 area as in a wave C. In order for that count or that position to stay alive, it needs to stay under this high right here, which is 677, which is 677. And as long as it stays below that, then that count is intact, and you're looking for a bigger 3-wave decline. What are the fundamentals that are going to drive it? Well, hey, we've been in a demand-led market in 20 and 21, and then 22 was really more of a supply shortage market. So, and the difference between demand-led and supply shortage is that the demand-led markets tend to go faster, farther, and last longer than the supply-led rallies. Supply-led rallies would be like the 2018 rally, where corn spiked up high and then just immediately collapsed, right? That was a good weather scare market. Demand-led markets have a lot more teeth to them, and a side effect of a demand-led rally followed immediately by a supply issue, caused by drought, are basis levels that go crazy because somewhere someone got short corn. So what we've had the last 6 months is just that. We've had extremely wild basis levels because the market has been trying to push available bushels to where they're needed the most. That's the job of basis. And when that comes to an end, it comes to a screeching halt. And so we're starting to see that break down just a little bit because the bushels have gotten to where they need to be. Now, what do I mean by that? Well, in parts of Nebraska, basis has dropped as much as 50 cents. I know around here, our basis levels have stayed firm, but they're off their highs, and they're not looking to get any stronger. So, contrary to what a lot of people read, which is, oh my gosh, basis levels are wild at harvest. What are they going to? Well, they must be really strong in April, May, June. I don't think that that's necessarily the case if we are adjusting from a demand-led rally to a supply-led rally to an adequately supplied and imbalanced market. So if 2023 is the year of balance and rebalancing, then these markets are going to revert to a carry. And so look what's happening in South America, right? Yes, I know we're talking a lot about drought in Argentina, but we have perfect weather in Brazil. And Brazil, over the next 4 months, is going to harvest their crop. And it's a long process. It takes a lot to get that crop harvested. But by all means, from what I can read, we're expecting a massive, massive crop out of South America on soybeans, which is going to pressure our beans and our corn. So what is this market set up to do? It's set up to reflect that. So that is why we are hedged. So this is old crop. Let's look at new crop real quick, and then I want to broaden it out and go to a bigger picture to kind of re-emphasize what we're talking about. So here's December corn, okay? 1, 2, 3, 4, 5. Week A, here's a B. We may get a little C up in here, but honestly, this chart looks worse than the March chart and looks set to challenge lower levels. This is why we've been recommending being hedged. We've fought it. We hate being sold in December. It drives me completely crazy, and we'd like to see it rally, but it certainly does not have to rally at all. Let's look at the weekly continuation chart. Okay, so here's your weekly chart of corn. This is always plotting the front month. This is 2020 when the market began to rally, and this is today. Look at where we are in relationship to this cloud. The biggest signals come when a price breaks out of a cloud and comes back and retest it. Here's 2020, here's a little retest, and boom, we're gone, right? As long as this cloud has held, look at what we've done recently. Even earlier this summer, this cloud didn't break lower. We held it. And now here we are testing the bottom side of it. This is why we want to be hedged, because anything below this level has got to be viewed as bearish and defensive, because this thing can accelerate lower faster than anybody will be on board for it. Now, look at where we are today, 653. Here's where we were last Christmas at 590. At the close was 592. This is last December 27th. And the Christmas before that was close at 485. So in this demand-led market, we went from a low of the 2019 Christmas of 385 to 485 in year one, demand-led. Next year, we added virtually $1, demand-led. And then this year, see this spike followed by a collapse? This looks more like a supply-driven issue, and we've put on 50 cents. So a lot more volatility, a lot steeper drop, and we finally have broken the bottom side of this cloud. So that's why in corn we are recommending and have been recommending that our downside be managed and protected. Now, I'm not promising that that's what's going to happen. We probably and hopefully will have to adjust this for higher prices, but the last 3 years we have been very aggressive and been very patient, and we've wanted to play the long side of this market. Because of all these developments, we want to play the short side, and we want to be very, very defensive as long as we remain in or below this cloud level. Now, if we break back up above it, we'll change our tune. But as long as we stay below it, we want to stay defensive. All right, that's corn. Now let's look at soybeans. Here's the March bean contract. We are still inside this wedge that has been unfolding all summer long. We are trying to break out the top of it, and we are putting as much pressure on the top of this thing as anybody wants to see. I mean, it really is pressing on this door pretty hard. Now, I don't know if we'll break it or not. I mean, everybody will know that at the same time, and there's no way to predict what's going to happen there. Argentina is dry. Brazil is perfect, and we're going to have a monster crop there. So how much can we rally in the short term? I just don't know. But everything about this suggests to us that we need to be hedged. Now, what does our weekly say on soybeans? Do we have the same view? Yep, here's our soybean issue, right? Here's where we were in 2020. Here's the last week of 2020. We're trading at 13.14. 2021, we ended right about 14. And then this year, here we are right at 15. So we've continued to have higher closes on year for 3 continuous years because of demand and drought. And now we have a perfect crop coming, and we're breaking out the bottom side of this cloud. So that's why we want to be very defensive with a quick sell trigger on beans as well, because there's nothing but space down here, right? You can just see that. We've got resistance up here. We've got space down here. That's why we want to be hedged and managed, no question. Now, let's look at soybean. Let's look at Novi beans. They're in a tighter coil than the March beans were or are, but they will come to an end and it will break out. March beans are trading right at the top of its range. Look where November is, right in mid-range, has no real direction or opinion. So we're still of the mind that we want to sell November on a move below this low at 1378. And if we do break up higher, fantastic. We'll figure out what gets us there and make adjustments from there. Now let's talk about soybean spec trades here just a little bit. We recommended selling soybeans right in here. Right at this 1477 level, and we recommended selling them with a stop against up here. That trade is still good, even though yesterday and today we've come back up. But what I didn't like yesterday is on Monday we had this big down day. I mean, this was a gap lower, a bearish engulfing bar, and it really looked like it should break this low right here and just accelerate on down yesterday, and it didn't do it, right? So that doesn't make the trade a bad trade. It's just the market saying not yet, or hey, maybe you're wrong. So what we did is we made an adjustment. So for those of you that are wanting to learn how to use options in a position, what we did is took a lot of risk out of the table. So at 1477 to the high is 23 cents. So what we did is said, hey, the bottom of this range is 1440. So we sold the 1440 put for 25 cents. And what that did is that put our break even, right? So the way you count that is you say my sale price was 1477. I collected 25 cents in option premium. So my sale price is now 1502 because I collected the premium, and that raised my sell point. So the way this trade works now is we have protection up to our stop level where we'll exit futures, of course, because we won't want to hold it on up higher, but we'll exit the futures and hold our short put, and we'll sell the futures again if it breaks down. Regardless of what happens there, as long as we hold our stop, our position will make money, or at least won't lose money because of that premium collected. Now, if we reverse and come on back lower, what we've done is we'll collect the futures move all the way to 1440, and we'll keep our premium we collected, which is 25 cents, which takes us all the way down to 1415, which is this area right in here. So you have basically a risk-free trade from 1502 down to this level down here. That's what we're doing. And if we break it lower, then you just say, hey, what's the next best choice? Do we sell more futures, or do we buy in the short put and look to sell another one lower and just enjoy the ride down? We can make an adjustment here, but sometimes you got to play defense when the market does this kind of thing with light volume and unexpected moves. But inside this range, what else should you expect other than difficult moves and unpredictability? Now, if we do break out the upside, I don't know what will cause that necessarily, but we really need to, if we're going to push this thing way higher, then it's got to be demand led, because the weather's just not conducive to enough of a shortfall to push us higher on weather alone at this point. We've got to see demand, and then another weather scare in our growing season later next spring or summer. But it's way too early to trade the long side of this market because of that. So that's our view on soybeans. Now, Kansas City wheat. All right, it just looks terrible, right? It just seems like it's down every day, trades huge ranges, and is miserable. But we're still looking for a bounce back into this $9 area, maybe even a little bit higher. And I want to show you why. First, what I want to do is show you the weekly chart. And on this chart, we have something that we don't have on the rest, which is we already have a mature move to the downside, but we have a massive bullish divergence on the weekly continuation chart right against these lows right here. So that setup right here is really very, very bullish and tells us that we don't want to press the short side because a bigger rally may continue or may unfold. So if we do break out beans, if they all do to go together, we can rally wheat all the way back up into this area, 950, between 9 and 950, depending on how quickly or how far corn decides to go. And what will cause that? I have no idea. Maybe it's our weather situation. Maybe it's the war. I don't know. But the reality is, it isn't a great sell signal like corn and beans are. Now, is it a break of logic to say that wheat can go up and while corn and beans go down? No, absolutely not. That's actually more normal than anything else because wheat can divorce itself from the other two, and it can put a wide premium on itself in order to preserve food supply for people. Remember, corn is a preferred feed alternative, and if it gets cheaper, then the cheaper it gets to wheat, the better that is for the cattle guys. So it's not uncommon or illogical at all for wheat to divorce itself and work higher. Now, I don't think it can go back to 14, 15 bucks, but I do think it can compress this 950 level, and corn break to 580. I think that's definitely doable and would be a welcome move. So we're looking up in wheat at in the short term. We don't have enough there to trigger a buy signal yet, but we are looking for that opportunity. And we are also looking to sell corn. Now, what we're going to do with wheat, and we've talked about this last week, I still like the idea of selling puts down here. I don't really want to do it right ahead of the holiday because of the low volatility that we're seeing, but I like the idea of selling puts and then adding to long positions if we get high enough, or rolling over and just selling it back up into a retest at the bottom of this weekly cloud. Does this daily chart count for that? Sure, absolutely. We've got a buy signal here on the 13. We're buying against all these recent lows right in here, and we have the beginnings of daily bullish divergences on wheat as well. Actually, that confirmed one right there on Monday. So bullish divergences across the board on wheat, and I think you got to look higher up into this area at least, probably back up in somewhere in here to start with. So that's what we've got for you today. Looking up in wheat, down in corn, down in beans, and we're going to play defense on both corn and beans for 2023 until we get back on top of those weekly clouds. And I don't think it can get much clearer or simple than that. And I think the only thing that can really hurt our marketing is if we get in the way of it and decide that we should just hold cash below those clouds. I think that's a mistake, and something that we would rather watch it work against us then you know, you would rather be sold corn up into this area and say, man, I wish we had that back, than long your cash down into this $5 area and say, oh man, I wish we'd have sold that. So that's the setup that we're working with, and this is telling us we need to lean towards protection. So I hope that's clear, and I hope that makes sense to everybody. If you have questions, please call us. Remember, there is risk in trading futures and options, and you should only do so in light of your own financial condition. If you have questions or want to talk through positions, please let us know, and we will be glad to help set those up for you. We'll talk to you next. We will not talk to you next week. We'll talk to you in 2 weeks, and I hope everyone has a Merry Christmas and a Happy New Year. Talk to you later.